Well, the announcement has been made. The BOC has cut interest rates by another 25 basis points. What is the strategy behind the decision? Will this actually help the economy? And, of course, what it means for your portfolio. Back with me to lean into this is my trusted partner, Michael Succurro from Spark Financial. Well, good morning, Michael. This is a big one. There's a lot of factors running behind this.
Good morning, Lindsay. Yes, there's huge factors running behind this. It's been a crazy couple of weeks trying to see what's going on with the tariff war, what's going on with the housing market, and of course, the stock market. Today, though, it was some great news, seen a quarter point. That is what we expected to come. As we mentioned before, they're not going to be increasing, I think, to half a point or a three-quarter point, given the fact that they want to ease into this rate decrease so they don't inflate the market again. Now, what we're seeing is a 2.75% Bank of Canada prime rate now, which again will instill more confidence in buyers. But the big piece now, as we've mentioned many of times in our past videos, is that those renewals are now starting. So March is officially the renewals of the 1.2, 1.3, 1.5% mortgages that people had received back in 2020. And that's creating some scary times right now. Affordability is a huge question right now as to whether they should stay in that current property or they're going to be able to renew.
Yeah, I mean, let's hit back on just this decision alone for the rate cut. Does this cut actually show confidence or concern? I mean, let's start with the big picture. The Bank of Canada isn't making this cut in a vacuum. There are still inflation concerns and employment hasn't completely collapsed. So is this a confident, proactive move to keep the economy on track, or is it a sign that policymakers see something troubling ahead?
I think this one has come across more as a concern. Definitely seeing, like I mentioned, with these new renewals that are coming up, a lot of people are concerned that they're not able to make these payments, and the banks are definitely concerned that they're going to have more delinquencies on hand. Just to give you a rough idea, clients that got a mortgage of 1.1 million with a Schedule A bank in 2020 was paying around $4,000 a month. Now, in the last 5 years, given the increase in rates, and they were in a variable rate mortgage, they didn't put too much away towards principal. So they're actually renewing now at 1.1 million again, and the payment has gone up to $6,200. So it's an extra $2,200 a month that's being added to their mortgage payment.
That's steep. I mean, historically, when we see that the BOC cuts rates, it's often meaning that they're seeing risks that haven't fully materialized yet. So this cut could be a signal that, yes, as you see, they could expect growth to slow further or that inflation might cool faster than anticipated. But on the flip side, it could also mean that there is a one and done move, a way to fine tune policy rather than fully do a pivot toward easing. So the key will be the next move, I think. If we see another cut in the next quarter, then we know they're more worried than they're letting on. What do you think?
I think we're definitely going to be seeing another cut. You know, their economists were saying that we're going to be seeing at least three more quarter point cuts. So I feel the next one will be a quarter point, and after that will be a quarter point, and then from there we're really going to be able to see the outlay of the market. Again, what I always mention to clients, investors, and anybody looking into the market is that the market is always 6 to 8 months behind. So this quarter point, we're not going to see the effects of it until 6 months down the road. So really, we won't know how exactly they're going to ease into this, but there are plans coming into play. There was talks the other day about adjusting the stress test. Again, we're probably 6 months to a year away from that, but at least the conversations are now happening because, again, this is not just going to be fixed with by cutting the rates. There has to be other factors that have to be put into place here.
Okay, so that brings me to the next key question then. Who actually benefits here? Lower rates should, in theory, boost growth, lower borrowing costs, but does this really help the average Canadian, or is this just about keeping financial markets happy?
Well, this in certain areas, this still does help the average Canadian that is looking to still purchase that point of entry home. We're dealing with a lot of first-time home buyers, and they're still very eager to purchase because at the end of the day, it's better off to own than it is to rent. And if you look back historically into January, February of 2020, even at the end of the 2019 year, rates were in and around 3.8 to 3.9%. And we're seeing now these first-time home buyer rates are anywhere as low as 3.4 to 3.6. Now, with this rate cut, they might come even lower. So it isn't a horrible point of entry. Again, everybody has that short-term memory loss where, they're fixated on the 1% rates. That was an anomaly that had happened, but we were usually averaging around, 3 to 3.5%. You see the odd 2.7, 2.9. This is pre-COVID time I'm speaking of. But this is still a good point of entry if it is a great price point you get into with as a first-time home buyer.
Well, the housing market is already out of control over there in Ontario, and it certainly is out of control over here in BC. So this is the tricky part. I mean, while lower rates theoretically help consumers by making debt more affordable, The reality is that many Canadians, they're already over leveraged. If anything, this could encourage even more borrowing, which isn't necessarily a good thing. Now, on the other hand, the markets love lower rates because they make equities more attractive than fixed income investments. We know this. So, in the short term, we could see a stock market boost, could we not? But for everyday Canadians, I mean, if you're already struggling with debt or can't afford a home, this cut probably isn't going to change your situation much. What do you think?
Yeah, we're stuck in a rock and a hard place right now. Typically, as you said, you would see, the cut in rates would boost the stock market. But as of right now, with tariff wars going on and the uncertainty that, your portfolio might drop one day by 50% because of something somebody said on the news, it's very weary right now. That's why you see someone like Warren Buffett sitting on over 330 billion in cash, because even he's waiting out to see what's the next play going to be.
Okay, so let's address the elephant in the room then, Michael. The global picture. Between tariffs, trade tensions, and economic slowdowns in key markets, how much of this cut is really about domestic policy versus the pressure of external forces? Is the BOC cutting rates because it wants to or because it has to?
I think it's definitely because it needs to. It needs to help Canadians. It needs to help strengthen their market because, again, this global tariff war is not assisting us at all. And the housing market is just the last piece the last piece of the cookie that's going to crumble, especially, again, with these renewals coming up and a lot of Canadians that I've already seen walk away from their homes. And it's just a small fraction of renewals that have already started to come up.
Yeah, that's a real concern. The BOC is in a tough spot for sure because they don't control trade policies. They do have to react to it. I mean, a tariff keep driving up costs for businesses. We could see inflationary pressures that can make it harder to justify further rate cuts. And at the same time, if global demand weakens and exports, take a hit, the BOC might be forced to cut again just to keep the economy afloat. So they're essentially walking a tightrope. Too many cuts could weaken the Canadian dollar and make, imports even more expensive, while holding steady could risk slower growth. It's a delicate balance act for sure. And I feel bad for all those people now that have to make that tough decision. Do we walk away from our home or do we fight through this?
Yeah, absolutely. It's definitely a slippery slope, and it's tricky, especially for the ones that had bought towards the end of 2020, 2021, where prices were just so inflated. And unfortunately, they're not able to refinance more equity out of their home as the value is most likely dropped in the last 4 to 5 years.
So what advice are you giving right now to your people who have to renew their mortgages or even on the investment side as well? What advice are you giving them?
On the investment side, I'm definitely, cautioning just to proceed with caution, especially with individual stocks, and look at the news in the sectors that are going to be affected. Again, we're looking at, the automotive sector. There's talks yesterday about implying 50% tariffs on steel manufacturing. So it's really understanding the news, what's going on. It's very, very important to watch the news, listen to the news, and read about it before making a stock pick if you don't have a financial advisor or financial planner you're working with. And on the mortgage side, again, it's talking with your mortgage experts, your mortgage brokers, your banks to understand what is the best option for you and understand how to, mitigate through these muddy waters to ensure that you don't lose your property or walk away. At the end of the day, you zoom out on the larger picture of real estate over the last 100 years, and it goes like this. It's on a steady increase. Yes, you'd have points where it does dip down, but it's always great to hold on to real estate. And if your financial planners, financial advisors, and brokers can assist you with that, I strongly recommend it.
Well, this is obviously just the tip of the iceberg with the conversation, and we want to hear more from you. What do you think? Was this cut a smart move, or is the BOC jumping the gun? Pop into the comments below and head to stockhouse.com for more conversations. I'm Lyndsay Malchuk here at Stockhouse with Michael Succurro. We will see you next time.